In December 2015, a group of idealists sat around a table in San Francisco and made a promise. They were going to build the most powerful technology in human history and give it away. No shareholders, no profit motive, no board demanding quarterly returns, just a mission. Make sure artificial intelligence benefits all of humanity. One of the men at that table was Sam Altman, a soft-spoken, hoodie-wearing guy who had just left Y Combinator, Silicon Valley's most prestigious startup accelerator. Another was Elon Musk, who at the time was best known for electric cars and landing rockets on drone ships. Together, they co-founded OpenAI as a nonprofit. They put their own money in, they recruited the best AI researchers in the world. They were, by every measure, the good guys. That was 11 years ago. On June 8, 2026, Sam Altman filed paperwork with the SEC to take OpenAI public at a valuation of up to $1 trillion. $1 trillion. For a company that was legally forbidden from making money when it was founded. And here's the part that the IPO paperwork won't lead with. The nonprofit is still there, it still exists, it still owns a piece of the company, but the mission statement has been quietly rewritten. A key word has been deleted. And the man who wrote the original promise is now suing to stop the whole thing. This is not a story about artificial intelligence. This is a story about how a promise gets unwrapped, repackaged, and sold back to you at $1 trillion markup. And if you're thinking about buying OpenAI stock when it lists this autumn, you need to watch this first. Because the most important risks won't be on page 1 of the prospectus. To understand what's actually happening, you have to go back to the beginning. In 2015, the smartest people in AI were quietly terrified. Google had just acquired DeepMind. Facebook was building its own AI lab. The race was on, and it was being run entirely by companies whose primary obligation was to their shareholders. Sam Altman, Elon Musk, and a handful of others decided to do something unusual. Build a lab that had no shareholders to answer to at all. OpenAI was incorporated as a 501(c)(3), the same legal category as a hospital or a university. The charter was explicit. OpenAI's assets were, quote, irrevocably dedicated to a humanitarian mission. They could not legally be redirected for private gain. It wasn't just a marketing line. It was a legal constraint. For the first few years, it worked. Researchers published their findings openly. The name OpenAI actually meant something. But then they started training bigger models. And bigger models cost money that no donation drive could cover. By 2019, the bills were becoming impossible. So they invented something new. They called it a capped profit structure. Investors could put money in, but their returns were capped at 100 times what they invested. $1 in, $100 out, maximum. Anything beyond that flowed back to the nonprofit. It was a creative solution. And for a while, it attracted enough capital to keep going. Then ChatGPT launched in November 2022, and everything changed overnight. Within 2 months, ChatGPT had 100 million users. It was the fastest consumer product adoption in history. Suddenly, OpenAI wasn't just a research lab. It was a product, a business, a potential empire. And the capped profit structure, the thing that made investors feel safe about the mission, became an obstacle. Because the investors who came in after ChatGPT, they didn't want 100 times cap. They wanted unlimited upside. So in October 2025, the cap came off. OpenAI restructured into something called a public benefit corporation, a for-profit company with a charitable mission written into its charter, legally similar to Patagonia or Ben & Jerry's, except valued at $500 billion. Here's the detail that will be buried deep in the prospectus. When OpenAI was a nonprofit, Sam Altman owned zero equity in the company he built. Zero. He ran the company. He was the face of it. He negotiated the Microsoft deal. He pushed every major product release. And he owned nothing. That changed with the restructuring. Under the new corporate structure, Altman received an equity stake approaching 7% in the newly formed for-profit entity. At a $1 trillion valuation, that's roughly $70 billion in personal wealth, created by converting a nonprofit into a commercial company. Now, to be fair, people who build companies deserve to be compensated. That's not the controversy. The controversy is what those assets originally were. They were charitable assets, donated by people who believed in the mission, dedicated, by law, to benefiting humanity. And they are now worth tens of billions of dollars to a private individual. California Attorney General Rob Bonta and Delaware Attorney General Kathy Jennings both looked at this conversion very carefully. They negotiated. They pushed back. They extracted concessions, independent oversight, quarterly monitoring, a requirement that OpenAI stay in California, and then they signed off on it. Whether that's justice or a settlement, that's a question reasonable people disagree on. What's not in dispute, the man who ran the nonprofit is now pending IPO, one of the wealthiest people on earth. And the people who originally donated to that nonprofit got nothing. But before we talk about where OpenAI is going, we need to talk about what happened on a Friday afternoon in November 2023, because it tells you everything about how this company actually works. On November 17th, Sam Altman was called into a video meeting with the board. He thought it was a routine check-in. It was not. In the space of about 15 minutes, the board fired him. The reason they gave? A lack of candor. He had not been consistently honest with them. And then something remarkable happened. Microsoft, which had invested over $13 billion in OpenAI, made an announcement. They were hiring Sam Altman, and they'd take the entire team with him if needed. More than 700 OpenAI employees, almost the entire company, signed an open letter threatening to quit and follow Altman to Microsoft unless the board reversed its decision. Within 72 hours, the board capitulated. Altman was back. The directors who fired him were gone. Think about what that moment revealed. The nonprofit board, the entity legally in charge of the mission, tried to exercise its authority, and it failed completely. The lesson the market took from November 2023, the governance structure at OpenAI is decorative. When it conflicts with commercial value wins. Elon Musk left OpenAI's board in 2018. The official reason was a potential conflict of interest with Tesla's AI development. But years later, Musk told a different story. He said he had been pushed out. In 2024, Musk filed a lawsuit. The allegations were serious: breach of charitable trust, unjust enrichment, and a fundamental betrayal of the contract OpenAI had made with the public. On May 18, 2026, the jury ruled against Musk. But here's the part that matters. The case was not dismissed on the merits. The judge threw it out on a technicality. Musk had publicly complained about OpenAI's direction as far back as 2020. The court never ruled on whether the conversion of charitable assets was ethical or lawful. It ruled on timing. Musk, of course, is not a neutral party. He has his own AI company now. His motivations are complicated, but the question he raised doesn't go away just because he raised it. When you convert a nonprofit into a trillion-dollar company, who did the converting benefit? Here is a small detail that almost no one is talking about. When OpenAI filed its nonprofit tax forms in 2022, its mission described building AI that safely benefits humanity, unconstrained by a need to generate financial return. When it filed its forms in late 2025, that mission had been quietly changed. The word safely had been deleted. The phrase unconstrained by a need to generate financial return had been deleted. What remained? To ensure that artificial general intelligence benefits all of humanity. Around the same time, OpenAI quietly disbanded its internal mission alignment team. Roughly half of its frontier safety researchers departed throughout 2024, many of them publicly citing the same reason: safety had been deprioritized. One former safety lead said publicly that the governance structure had succumbed to a pull toward profits and could no longer be trusted to independently regulate the deployment of highly capable models. The IPO prospectus will talk about safety commitments. It will name the Safety and Security Committee. It will name the one board member, Dr. Zico Coulter, who sits only on the nonprofit board and attends the commercial board as a non-voting observer. One non-voting observer watching over a trillion-dollar company. When was the last time a non-voting observer stopped a company from doing something profitable? Let's talk about the actual business, because the story of how it makes and loses money is genuinely fascinating. By the end of 2025, OpenAI was generating roughly $20 billion a year in revenue. That is one of the fastest revenue ramps in the history of software. The problem is what it costs to generate that revenue. Every single time you type a message into ChatGPT and hit send, a GPU somewhere fires up and processes your request. That GPU costs real money every single time. Traditional software doesn't work like this. When you stream a song on Spotify, the marginal cost of that stream is essentially zero. AI inference doesn't scale that way. The costs are real, they're large, and they don't disappear as you grow. In 2025, OpenAI spent somewhere between $7 and $9 billion just on GPU compute, most of it running through Microsoft's Azure cloud. That's roughly 40 cents of every dollar of revenue going straight to server costs before OpenAI pays a single employee. The result? Even as revenue tripled in 2025, the gross margin actually fell. They made more money and kept less of it. OpenAI insiders believe the company could be profitable if costs come down, if the next generation of chips is cheaper, if inference becomes more efficient. But may happen is not the same as will happen. And the prospectus won't put a date on it that you can hold them to. What the prospectus will bury in the footnotes, the company needs to raise roughly $600 billion in capital by 2030 just to fund its infrastructure plans. That's why they're going public, not because they're ready, because they have to. There's another thing the prospectus will minimize. The competition is catching up. When ChatGPT launched in 2022, it had no real rivals. It was first. It was extraordinary. The moat seemed enormous. Today, the landscape looks very different. Google has Gemini built into every Android phone, every Gmail account, every Google search. Meta has Llama, and Meta gives it away for free. Developers can download it, run it themselves, customize it, deploy it without paying Meta a cent. And then there's Anthropic, the company founded by former OpenAI researchers who left, in part, over safety concerns. As of June 2026, Anthropic's private valuation surpassed OpenAI's for the first time. The company that OpenAI's own alumni built is now worth more, at least on paper, than OpenAI itself. OpenAI set an internal goal for this year: 1 billion weekly active users. They didn't hit it. Their own CFO warned internal staff that the company missed monthly revenue targets multiple times in 2026. None of this means OpenAI is failing. It isn't. It's still the most recognized AI brand in the world. But a company valued at $1 trillion isn't being priced on where it is today. It's being priced on the assumption that it dominates the next decade the way Google dominated the 2000s. Let's talk about you for a second. If you're watching this, there's a decent chance you're thinking about buying OpenAI stock when it lists. The name is familiar. You use the product. You believe in the technology. It feels like a safe bet. Here's what history says about that feeling. Uber went public in 2019. A year later, it was trading at $31. The people who believed in ride-sharing and bought at the IPO lost nearly a third of their money in 12 months. Lyft listed the same year at $72. 1 year later, $26. That's a 64% loss for anyone who bought on day one. Rivian, the electric truck company everyone was excited about, listed in 2021 at $78 a share. It subsequently collapsed by more than 85%. The pattern isn't hard to see. A company builds genuine technology. It generates genuine excitement. Venture capitalists invest early, at low valuations. The company grows, the hype builds, and then it goes public. At the peak of the hype cycle, at the maximum valuation the market will bear. The institutional investors who got in at lower valuations, they're not holding, they're selling. The IPO is their exit. You are the exit. OpenAI's underwriters have announced no retail allocation plans, no dedicated block of shares set aside for individual investors. That means retail investors don't buy in at the IPO price. They buy after trading begins, when institutional demand has already set the level. None of this means OpenAI is a bad company. It may be the most important company ever created, but important and investable are two very different things. Go back to that room in San Francisco in 2015. The people around that table were not naive. They were some of the smartest technologists alive. They chose the nonprofit structure deliberately, not accidentally. They believed the mission required insulation from profit pressure. What happened over the next 11 years is not a simple story of greed. It's more complicated than that. The capital requirements were real, the competition was real, the pressure to ship products was real, and along the way decisions were made. Small ones, mostly. A structure tweaked here, a word deleted there, a lawsuit dismissed on a technicality. None of it was necessarily illegal. All of it was, in some sense, rational. But taken together, what you end up with is a company that was founded to be a gift to humanity and is now being sold to the highest bidder. Maybe that's fine. Maybe the technology is so important that whoever builds it, for whatever reason, benefits everyone. Or maybe the paperwork was always going to win. Either way, if you're going to invest, read the footnotes, not just the revenue slide, not just the user numbers. The footnotes. That's where the real story of any company lives. And with OpenAI, the footnotes have never been more interesting or more expensive to ignore.